An AI bubble doesn't begin when the technology stops working. It begins when spending stops waiting for proof. Big tech is cutting jobs, planning close to $800 billion of annual investment, and locking itself into what one viral headline called $1.65 trillion of hidden AI debt. So, is the bubble starting to crack? Not yet, but the way this boom is being funded has changed, and that's the warning. Start with the layoffs. Microsoft cut about 4,800 roles this month and said explicitly those jobs weren't being replaced by AI. Yet employers attributed more than 100,000 planned U.S. job cuts to AI in the first half of this year. And among firms already using AI, the U.S. Census Bureau found that 95.7% reported no AI-related employment change. Those facts sound incompatible. They aren't. A layoff announcement tells you that a job disappeared. It doesn't prove a model performed that job, and a company can cut people because of AI without replacing those people with AI. How? By moving the money. And that matters whether you're watching your career or your index fund. Alphabet, Meta, and Amazon reported about $292 billion of combined capital spending in 2025. Their accounting definitions differ, and not every dollar was AI. But the direction is unmistakable. More money for data centers, chips, and power. More hiring for scarce technical talent. Fewer management layers. Slower general hiring and less room for lower priority work. For employees that can still feel like AI took the job. For the company, it's a capital allocation decision. That's why the clearest labor signal may not be the worker replaced by a chatbot. It's the vacancy that never opens. A 4-country executive survey found that more than 90% of firms reported no AI employment impact over the previous 3 years. But when executives expected future reductions, roughly 2/3 said they'd achieve them by hiring fewer people, not by firing existing staff. Stanford's payroll indicators show the weakest employment growth among workers aged 22 to 25 in highly exposed occupations, including software and customer service. That's not proof of an economy-wide AI jobs crash. It's a warning that the entry door is narrowing. Now follow the savings. FactSet estimates the 5 largest U.S. hyperscalers could spend more than $690 billion across their 2026 fiscal years. On a calendar year basis, guidance approaches $800 billion when finance leases and customer prepayments are included. Their combined cash investment was about $95 billion in fiscal 2020. This isn't normal growth, it's a new financing regime. And that's where the $1.65 trillion headline enters. It's real. The label isn't. A reconstruction of public filings found about $821 billion of leases for facilities that haven't started yet, plus about $829 billion of purchase, construction, and other contractual commitments. Add them together, and you get $1.6507 trillion. But you don't get $1.65 trillion of secret loans. Recognized interest-bearing borrowings across those 5 companies were closer to $430 billion in the same reconstruction. The rest includes future payments for data centers, servers, chips, network equipment, energy, and capacity. Some contracts run for decades. Many amounts are undiscounted. Microsoft's subtotal even mixes reporting dates. And none of it was found in a hidden drawer. It was disclosed in SEC filings. So why should anyone care? Because not debt doesn't mean optional. If you hold a broad U.S. index fund, these contracts already touch your portfolio. An uncommenced lease is a signed promise to rent an asset once it's ready. A purchase commitment can require the company to buy power, equipment, or compute capacity as a supplier performs. The company receives something valuable in return, but the payment can survive even when the expected return doesn't. That's the real bubble test. Not whether AI works, whether AI revenue arrives before the fixed costs do. Moody's counted $969 billion of undiscounted future lease commitments at the 5 hyperscalers at the end of 2025. About $662 billion hadn't commenced. Moody's said those unstarted leases alone equaled 113% of its adjusted debt measure for the group. Once those facilities come online, rent begins. Then come the chips, then power, then depreciation. Compute hardware may be useful for only 4 to 6 years, even when the building lasts much longer. If demand disappoints, the company can't simply turn a specialized data center back into cash. And it's spreading beyond big tech's own balance sheets. The Bank for International Settlements describes a common structure. An outside vehicle builds the data center and raises debt from private lenders. The tech company may hold a minority stake, then supports the project with a long lease, a capacity contract, or a guarantee. The builder holds the loan. The tech company supplies the cash flow that makes the loan possible. The BIS calls that narrower mechanism shadow borrowing. It also connects the AI boom to private credit funds, insurers, and banks that provide financing lines. That doesn't make it Enron. There's no evidence here of fake transactions or fraudulent filings. But it does mean the risk can move without disappearing. If you only look at big tech's reported bonds, you can miss the debt sitting one contract away. This is also where the bear case can get too dramatic. These aren't cash-burning.com startups. Morgan Stanley says the large hyperscalers remain among the strongest credits in the market. FactSet estimates 4 of the 5 still have total debt to EBITDA around 1 times or less. Demand is real. Alphabet, Microsoft, and Amazon reported about $1.46 trillion of remaining performance obligations at the end of March. That's contracted future revenue, not cash, not profit, and not a perfect offset to the commitments. But it proves customers aren't imaginary. Morgan Stanley estimated AI-related debt issuance was already close to $250 billion by mid-June and could reach $500 billion for 2026. Its concern for the strongest issuers wasn't near-term insolvency, it was the sheer supply of financing, plus growing complexity and project-level deals. So the choice isn't AI revolution or AI fraud. A technology can be transformative and its infrastructure can still be overfinanced. We saw that in telecom. During the late 1990s, companies laid enormous amounts of fiber for internet demand that was absolutely real. Federal Reserve research later noted that more than 90% of the optical fiber cables installed during the decade were left unused when the boom collapsed. The internet won. Many people who financed excess capacity didn't. But today's difference matters. Big tech starts with enormous operating cash flow, established customers, and profitable cloud businesses. That gives it far more time than the weakest telecom borrowers had. So, is the AI bubble starting to crack? The layoffs alone don't prove it. The $1.65 trillion headline doesn't prove it. But together they show what management is prioritizing and how much future cash is being attached to that decision. If you want to know when a capital spending boom becomes a financial problem, watch 3 things. First, cloud growth and contracted backlog. If those slow while capex and new commitments keep rising, demand is losing the race. Second, free cash flow, depreciation, and interest. If the costs of yesterday's build-out rise faster than operating profit, shareholders start paying for the gap. Third, what happens to unused capacity? Watch for canceled projects, subleased compute, impairment charges, weaker lease terms or guarantees being activated. And for workers, keep watching the missing vacancy. If weakness among young people spreads across ages, industries, and datasets, the labor warning has become something larger. The bubble hasn't burst, but big tech is already making the trade that matters. Fewer flexible costs today, more fixed AI commitments tomorrow. The technology doesn't have to fail for that trade to hurt. It only has to pay off later than the contracts expect.